Welcome, everyone. We have a few more people connecting, so we'll give them a few seconds. Welcome. Thank you for joining us tonight. My name is Alyssa Dominioni, and I'm an MBA 2018, and I work for Alumni Relations in the HEC UK office with a team with Delphine Moreau, who's here with us, Director of the HEC UK office, Lauren Unthank, Christina, Keo, and Wendy as well. So great team of 5, and we're delighted to be here with you tonight. Just before we go into more details about Hervé's story introduced by Matthias and thanks to our UK Finance Club, I would like to give you a few updates on some of the events and a bit of news about HEC. So first of all, thank you very much to Matthias from our UK Finance Club for organizing this event. And thank you to Hervé for his presence and sharing his story with us tonight. A reminder of upcoming events. We have an event for parents about families and how to balance family life with Nadim Saad on the 2nd of February next week. A Boost Your HEC Network in Americas on the 2nd of February as well. A blockchain event organized by our digital club on the 10th of February. A sharing and growing talk at the end of February. The Wirecard story in March. And a lot of other events. You can find all of these on the HEC alumni calendar. You can also follow our HEC UK LinkedIn page. We have an Instagram account, and we also have WhatsApp groups. If you're an HEC alum based in the UK, you can contact Christina to be added to the WhatsApp group and make sure you get weekly reminders of our events. And finally, if you are going through career transition, remember that we have mentoring services on the HEC Pulse platform, and we also have coaching access, where you can select among certified coaches that have been selected for you. Our magazine is the HEC Stories, online or in paper, where you can find podcasts and videos and great stories about industries, but also about our alumni. We are able to do all of this thanks to alumni who support us through the Infinity Pass or the fee-paying membership, the annual membership. So if you haven't and you are able to, please consider that. We were ranked #1 in the world as a network, and it is thanks to the strength and the involvement of our community. And we're always happy to hear from you. So feel free to join us or contact us at the HEC UK office or at HEC Alumni. On that note, thank you again, Matthias and Hervé, for this event. And we look forward to hearing more about the club and about your story, Hervé.
Great. Thank you, Alyssa. So hello, everyone. I am very pleased to bring you today the amazing case of Meliorto. And before we begin, I think there are 2 very important remarks to be made. First of all, we'll get the insider insights on 3 different leverage buyouts on the same company, but at different stages. We will hear from the CEO on how he sold the company 3 times, what were the challenges at each stage, and how he delivered value. Now, let me point out how relevant this is for us, people working in M&A, as we typically take the view from the investor's point of view, either the buy side or the sell side. Now, the second important point that I want to remark is about Meliorto, which is a rare case of a European company playing in retail fintech that has experienced not only an incredible growth, but also, and most importantly, a sustainable profitability. We've seen some retail fintech companies experience high growth in the last couple of years, but they've grown fast without being profitable. Today's case is different. The agenda for today is as follows. Hervé will give us a brief presentation about Meliorto, and then we will go through these 3 LBOs. Please, as we go along, type any questions that you would like to pose to Hervé during the last 10 to 15 minutes, and we will select a couple of your questions and Hervé will answer them. Now, without further ado, let me introduce you to a wonderful speaker, Hervé Hatt, the Chief Executive Officer of Meliorto. Hervé graduated from HEC Paris in 1986 and has an MBA from Stanford. In his early years, he worked for McKinsey and then joined AXA, where he became the CEO of AXA Bank in Europe. Then, in July 2011, he took over the management of Meliorto as its Chief Executive Officer. And Hervé will tell us tonight about this amazing journey. Hervé, over to you, and thank you for your time.
Well, thank you very much, Matthias, and thank you for all the HEC team to inviting me tonight to say a few words regarding what we have done at Meilleur Taux until now. Let me correct one thing first. I'm no longer the CEO. I used to be the CEO until the 1st of August of last year. Now I'm just a chairman. So I'm in a non-executive position, but I've been running the company as CEO for 10 years. So I remain involved, although in a different capacity now. So I guess I have a bit of time now to tell the story, which is still ongoing as we speak. I think I should share the screen because I've got a few slides with me, which I would like to share with you. Let me try to make this work. Hopefully this is going to work.
Yes.
Not if it does, great. It looks like it does work. So what I would like to do is just to take a few minutes to say a few words about Meilleur Taux, especially for the non-French attendees who may not know anything about us. Roughly speaking, Meilleur Taux, which is now the group Meilleur Taux, is the leading player on the French market as far as comparison and brokerage of retail financial products is concerned. In the past, people used to go to Meilleur Taux to know what the best rates on loans, mortgage loans would be online, and now also offline with branches. We do the same now for all kinds of insurance products, and we now also do the same for investments and savings products with Meilleur Placement that we launched back in 2019. So we are very much a wide platform for comparison and brokerage and advice for financial products for individuals on the French markets. I'm trying to switch to the next slide. So really our key focus in life is to help customers find the best financial products for their needs, starting with mortgages. And as you can see at the bottom here, we are now on our third LBO, the first one back in 2013, going from BPCE banking group into ownership by Equistone partners and management team. In 2017, we moved from Equistone to Goldman Sachs Private Equity. And in October of last year, October 2020, we moved from Goldman Sachs to Silver Lake as our new financial sponsor going forward. This is a summary on that page of what we have done since 2013. When I took over back in 2011, the company, which had been founded in 1999 as a pure web startup, was in very bad straits, very dire straits, almost going bankrupt. So the first year, 2011, 2012, was devoted to a complete turnaround and restructuring, then the sale to Equistone in 2013. Then we had rapid growth and several build-up acquisitions from 2013 to 2016. Then the LBO with Goldman back in 2017. Then more growth from 2017 to 2020 with a number of other acquisitions, 3 acquisitions in 3 years. And here we are in the third LBO with Silver Lake that took place back in October of last year. The starting point for the Meilleur Taux adventure was mortgage loans. Why mortgage loans? Because mortgage loans is what the company started with, online mortgage loan brokerage, i.e. find the best possible rates and best possible loan for your project. And it's a very good starting platform for us because basically on the French markets, when you talk about retail financial services and when you look at the popularity of searches on Google, the most searched products on Google for financial products is mortgage loans. This is the first thing that people are looking, or the most popular search on Google. And on that slide, the footage or the area of each square is proportional to the popularity of searches on Google. So you can see mortgage loans and loans are very popular, the most popular categories for searches regarding financial products on Google. So as we are very well placed in that space, therefore we are very well placed to tell people about other products. And when people come to see us for mortgage loans, they say, you do also insurance and savings and so on. And that provides us with a lot of free traffic to go into the other verticals. The service have expanded over time. When I started out back in 2011, we were only doing mortgage loans and a little bit of mortgage insurance, but 95% mortgage loans. Now we are very diversified and mortgage loans for us only 20% of revenues. And we are now covering all retail financial products across the board, and even now some non-financial products such as choosing the right gas and electricity contract or broadband contract for your home. We have a number of things we really distinguish us on the French markets. From the brand name standpoint, we are far above anyone else in our category on the French market with the highest brand recognition in our category. We are also #1 on Google in SEO, in free search, which is fantastic for us for traffic. Whenever you type Crédit Immobilier or any combination of keywords around Crédit Immobilier and mostly Crédit, we are going to come up first on Google, which is very helpful also for traffic purposes. This is what you see in terms of numbers. We had more than 90 million visits in 2019. Sorry, we haven't updated the slide for 2020 because it's still very fresh, but it's pretty much the same numbers actually growing in 2020. So we are a very largely, widely visited website, a series of websites regarding financial products in France. We are also very quoted in the press, which is for us a major driver of traffic. And we do spend a huge amount of time with the press to be quoted as often as we can. And this is a fantastic engine for traffic for us across all the categories. We are by far the most visited websites when it comes to actually researching loans, and now more and more also about insurance and investments on the French market. We have a series of tools which are proprietary on the IT side, which allows us to deliver online services across almost all of the categories. And we have also, and this is very odd, there are very few players in Europe having done that. We have gone from being fully online to being now online and offline. So we have gone the other way compared to many other companies across the board. We have not only an online capacity, which is the starting point of Meilleur-Taux, but we have also now added branches, and we have 350 franchise branches across France. And I don't have to go to the time to go into that, but it's very helpful for us to have both online and offline. And a lot of the online traffic and online applications from customers are actually directed toward the branches. And for us, it's a major source of customer service and also obviously revenue growth. We have over time made a number of acquisitions. We have bought 8 companies over time, and every time we have bought a company, it has added one new vertical to our business model. For instance, we bought a company in the domain of debt consolidation. When you repackage many loans into one, we bought a specialized company that's in that sector back in 2014. We bought an insurance comparison website back in 2016. Called Le Comparateur Assurance, which now runs under Le Comparateur Assurance or Meilleur Assurance. We bought in 2019 a company called Mon Financier, co-founded by another classmate of ours, Marc Fiorentino, and we have renamed that Meilleur Placement. And I encourage you to subscribe to Marc's morning zapping newsletter every morning, which is very exciting and which has more than nearly 400,000 subscribers now, and it's become a major plank for Meilleur Placement. So over time, we have added companies through build-up acquisitions, and that's helped us really just cover the full spectrum of retail financial products as a mix of organic growth and acquisitive growth. As you can see on that slide, I will not go into the details now. We are pretty much covering all the domains of retail financial products with the Meilleur-Taux brand and some associated co-brands, which are always using the Meilleur-Taux radical or the Meilleur radical. At the bottom, you can see that we have also some B2B operations, leveraging our capabilities, especially on mortgage insurance, which is assurance emprunteur or assurance de prêt. And we are doing B2B. And whenever we do B2B, we don't use the Meilleur-Taux brands, we use specific B2B brands. Key numbers, I will not disclose here any specific numbers regarding revenues and EBITDA, just to say that we have doubled our revenues and EBITDA during the period from Equistone to Goldman Sachs. And we have also doubled revenues and EBITDA another time from 2017 to 2020 when we were having Goldman Sachs as our financial investor. And we definitely plan to do that for the next few years again. We have a lot of priorities. I will not bore you with the details, but what we want to do is to keep on growing the business from a client standpoint, from a capability standpoint, from a brand standpoint, from a technology standpoint. And from a corporate standpoint, we have a number of challenges ahead of us. Obviously, we want to confirm that we have been able to operate in 2020 being completely COVID resilient. I mean, operations have continued with no glitch and no interruption whatsoever. we can operate 100% online digital, and the branches have managed to keep on operating all throughout the various lockdowns, either online or offline. We plan in 2021 to resume fully the growth momentum that we had until the first lockdown. We intend to invest faster in some booming verticals, one of them being savings and investments. I mean, we made a fantastic year in 2020 in the savings and investments domain with Meilleur Placement. And lastly, we plan to leverage Silver Lake's access to technology, because Silver Lake is a tech-focused fund, and for us, it's very important going forward. Well, I think, Matthias, I've gone through my time allowance. So I think that's all I would say regarding the background on Meilleur Taux. And now it's up to you for any questions you might have.
Yes, I think that's an amazing introduction. Thanks for that, Hervé. So
should I switch off the slide sharing? Do you prefer me to take the slides off?
Yes,
okay.
If you can, let's do that. So to begin with, I want to take you back to the start of this journey, to 2011. And first of all, it's perhaps a more personal question. Before you joined the company, before you took over, how did you assess Meilleur Taux? And I assume that you were in a pretty comfortable position. And what were the upsides and the risks of you taking over the business? Because as you said, this was perhaps a non-performing business.
Well, yes, I must say on this one, I got it pretty wrong. Before accepting to take the job, I did a bit of due diligence from the outside, only from the outside because the CEO I replaced was not aware I was going to come on board. So he was dismissed in a board meeting at 5 p.m. And I was introduced at 6 p.m. On the same day. So, and he was not aware of anything. So it was, well, it's something to experience once in your life. So I did a bit of outside-in due diligence on my own, and I talked obviously to the shareholder, who was Groupe Banque Populaire Caisse d'Épargne, BPCE. I did some due diligence on my own before taking the job, but to be honest, I failed to fully acknowledge the severity of the situation, how bad the company was doing from a financial standpoint. So I thought it was going to be easier than I thought, but after 1 week after taking the job, and after 1 week, I came back to the shareholders, to BPCE, and I said, look, it's worse than you thought, and it's worse than I thought. And it's not going to be a simple cleanup and homestaging to be done before you can sell this company, because I was asked to come in and organize the sale of the company. I said, look, it's going to be a deep restructuring. And I will come back to you with numbers another week, but it's going to be pretty bad. And it will have to be a deep restructuring. And that's what happened. After 2 weeks, I came back and I said, look, guys, forget the homestaging and forget the quick turnaround. There is no way to sell the company at this stance. It's going to be completely restructured, and it's going to take at least 1 year. And it took one full year.
So I guess, I mean, you were definitely surprised with that. But then once inside, what did you see, and how did you analyze the company, and what were the measures that you take? Because I think, as you just pointed out, I mean, it wasn't an easy restructuring. It wasn't just changing a couple of things here and there. What was needed to be done, and how did you come up with that conclusion and that plan, and how did you execute it? Because I think turnarounds that are sometimes quite hard to properly execute.
Yes. The first thing I did upon arriving was actually to go around the company in several places around France. And I found out a lot by talking to people. I mean, the conseillers in the branches and people on the telephone platform. The second thing I did was pretty much to fire the entire management team. So I would say within 1 week, half of them were gone. I mean, they were good people, but they were simply not going to be able to take the company to the next stage. And within 3 months, I think there was only one left, and everyone else was actually gone and being replaced. So the second thing was really to make a sweeping change in management team. And then the third thing was actually to build a plan. And we didn't take any consultants. We did it all on our own. And I would say whenever we had options, I went for the most radical option. Basically, we sat down with the head of HR, who was staying for some period of time, and the CFO, and they were pretty much the only ones left for a time. And then we took some very simple decisions, like shut down all of the salaried branch network and go for franchise branch network. Go for, let go half of the workforce, half the staff, So if we went for the most radical things. There was no need to have consultants for that. The numbers were pretty telling. And whenever there was some options, I would say we pretty much went for the most radical option. Because one thing I noticed is that in France, whenever you do something, people scream and kick and shout and complain, right? So I figured out because they are going to complain anyway, you might as well go for the big thing. Because if you go for small things or big things, they will complain all the same. So you might as well go for the big things. And we took almost in every dimension, we took the most radical action possible. And that's what we decided to do in the next the first month, basically.
Yes. And so if I'm hearing correctly, none of these problems were consequences of the global financial crisis of 2008 or the Euro crisis. These were more internal operating problems, correct? Was this your assessment? Or
yes, there was a bit of leftover from the crisis in 2007, 2008, in the sense that there was still sometimes some issue with partners like banks being a bit tight on providing funding or being able to provide enough loan capacity. But that was not really the core issue. The core issue was that the company just got in a bad way because of mismanagement and the wrong choices, and also maybe having the wrong shareholder. I think BPCE is a great company, is a great banking group. It's simply not fit to own a startup company like Meilleur-Taux. It was just the wrong combination. And altogether, that made that the company had made the wrong choices over time with a number of people that were just the wrong team. And that was really the cause of the issue.
Yeah. And this is a very interesting point, because you said that the shareholder was not the right one, BPCE. So how did it happen that you went through this year and a half, 2 years of restructuring the company to go into the first LBO? How did that happen, and how the whole sale process happened? I mean, how did that go about?
Well, it was quite, well, it sounds very simple, but obviously it wasn't simple. It went in 2 stages. The first stage was to go to BPCE and to say to them, look, guys, this is just not going to work. I mean, you've got to allow deep restructuring of the company, and only then can we put it on sale. And to the credit of BPCE, and at the time, people like François Perrol and François Ariaï, they said, yes, go ahead, just do it. And I was given license to restructure it completely. And we did it. And we were able to, a plan social, which was a sad thing to go through, but we were able to do a very deep plan social. We went from 300 employees to 108 in 18 months. And we did, that was the first phase, massive restructuring. That was quite painful, obviously. We had issues with the unions, comité d'entreprise, and so on and so forth. But in the end, it happened. It all happens. That was phase 1. And as soon as on the 1st, I think, of April 2012, we got the final stage of negotiating with the unions and the comité d'entreprise. Then we initiated the restructuring, including the layoffs. And then back at the end of August, when we were all exhausted and coming back from 2 weeks vacation, then BP said to me, okay, fine, now sale. So then we started in phase 2, which was initiating the sale. So prepare the info memo, data room, prepare the VDDs. And that was second stage. And it was all concluded in April 2013 with the sale to Equistone and to the management team.
Yes. And on that point, how did you pitch the company? Because, I mean, most of these buyers, for sure, they were buying a company that has just been restructured. But how did you position the company to them? I mean, they were not buying an entirely a company that was a complete disaster, but they were not also buying a company that was yet in full shape. How did you present it, and how did you increase the value for BPCE, which was the shareholder?
Well, we sold to Equistone, which, by the way, I think is a great private equity firm. If anyone around the table here is thinking about at some point working with Equistone, I fully recommend them. They are fantastic. For mid-market, I think they're just outstanding. I mean, great team. But that being said, I mean, we sold them 2 things. We sold them a team and a plan. The team was a new team. And then the plan was actually a plan, because the numbers in 2012, the company was still losing money in 2012. And 2013, the idea was to break even or make a small profit. So, but we put out a plan, and we said, do you guys buy the plan or not? Do you buy the team, and do you buy the plan? At least the management team is going to invest. We are keen to invest. And if you like the team, you like the plan, just go for it. It was a radical move for Equistone because it's not their core focus. They only buy, growing and profitable companies. They don't buy animals like us normally. So it was a bit of a bet for them, but I think we did manage to convince them that the team was okay and the plan was okay. And they made the bets. And it was, by the way, because we are loss making, there was no debt. So it was fully equity underwritten.
Perfect. So this takes us to the next stage of the company. So after Equistone acquired Meliorto, all right, now you went through the sale, fantastic. Then you sat down with Equistone. So what were the goals that you agree with them, right? For the next, let's say 2, 3, 4 years at that time? And a follow-up is, how did Equistone help you achieve those goals and execute the plan that you just sold to them?
Well, I would say that's the thing that was what we had the plan, and the plan was roughly speaking to I don't remember exactly all the numbers, but the plan was roughly speaking to make money in 2013 and to double up numbers or triple up numbers, revenue and EBITDA wise over the next 4 or 5 years. Actually, we did manage to beat the numbers every year, so we did better than expected. I think that one thing that they were convinced of, and that's something I would summarize in a quote from Jack Welch, the former CEO of GE back a few years back, many years back. He said, people before strategy. I think we had the strategy and we had a plan, but the most important thing that we had a team. And I think we managed to have a great team. And that was always for me, whenever there is a choice, if you need to prioritize something, prioritize having the right people, because if you got the right people, strategy will follow. And I think they trusted that. And so we had the plan and they always trusted the team. And that way things were just happening because we had the right people. I think that was very important. Another thing is that they backed us whenever we made choices that were not obvious at first. And I really learned a lesson here, which is when you are convinced about something, just persevere, carry on. And I will give you a specific example. When I started that, the company was doing only mortgage loans, 95%, and little bit of mortgage insurance, assurance emprunteur, 5%. And people kept on telling me, why do you bother with this? Stay focused. Why do you bother with mortgage insurance? Well, I stuck through it, and Equistone, backed me and backed us in that. As a result, by the way, now it's a more important product for us than mortgage loans, and it's a fantastic product area. And they backed us, and they backed us to the point where people said afterward, "Oh, what a great idea to be in this business." And persevere, because at the start people criticize you, and in the end they say, "Oh, this was a great idea." and they were very good at sticking with us and trusting us in making things which were not obvious at first. I would say that was fantastic. Another thing they did very well is that they knew their place. They knew where they would add value and where they would not add value. And where they would not add value, they didn't get into they didn't bother us. Because I think, in an NBO, the most precious commodity for management is time. Or at least that's what I found. And they were very careful not to annoy us and not to be wasting our time. And they really focused on M&A, which is, I think, where they really were able to help us. And they were almost our own internal M&A house. And that was fantastic because we did the deals with them and they were just an extension of the team. And they allowed us to make 4 or 5 build-up acquisitions in that period very successfully. And that was fantastic.
So if I'm reading you correctly, I mean, not only did they provide you with the capital for the acquisitions, but also all the internal knowledge of how to perform those acquisitions. That was sort of like an add-on to the company. Now, in those terms, how much
we didn't need capital because we were at that time starting to generate enough cash flow. We self-funded all of the acquisitions, or we took on debts. So cash flow from operations or taking on more debt, because we had no debt when we did the MBO back in 2013. Yes. So we're able, as we built the EBITDA, we were able to add debt, and we didn't need any fresh capital increase.
Well, that's fantastic. And then this is my follow-up question then. How much of the growth came from M&A in the period of 2013 to 2017, and how much of the growth came from organic growth, from the restructuring that you've done?
50-50. We bought, we bought 1 to 2 company a year, and small size build-ups, like, a value anywhere from 2 to 30 million euro. That was the kind of deals we did, adding every time a new vertical or new capabilities. So very, very synergistic. So in terms of growth pattern, that was, organic was 50% and build-up acquisitions were 50%.
Perfect. And then this brings me, because this was the period from 2013 and 2017. So how did Goldman came about? I mean, how did you decide with Equistone that was the right time to sell the company and to include another shareholder with perhaps a different view on the company? Because now you were not selling a travel business, you were selling a successful growth business. How did that whole transition happen?
Well, I've always spent a lot of time looking outside at other companies. And there are 2 companies that I found very helpful to look at, which is other companies engaged in similar LBOs or 1 stage further. For instance, I benefited greatly from talking to people like Frédéric Jousset at WebHelp, and or people like from my class, Christophe Chakia at InfoPro, both engaged in LBOs at a later stage because WebHelp was bigger and InfoPro, I think, also slightly bigger. And talking to them, I got a sense of the stages you've got to go through, and you see that at some point it makes sense to move to a next stage. I also talked to also another angle. I also looked very carefully and talked to much smaller companies, startups, fintechs, real fintech startups like launched in the past 2 or 3 years. The 30-something with birds, these kind of guys. And I looked at them for the culture and the creativeness. And when I look at these 2 kind of examples, more mature LBOs and real, very young, fresh, young fintech startups, I got the sense that somehow you need to move on to something else, like shedding skin or moving to a new scheme. And changing shareholders allows you to do that because it allows a team to crystallize some wealth and to reinvest for the next stage. Some people move out, other people move in. It allows you to bring on as shareholders more managers. And it's a very useful breathing time for the company. And at some point, I felt that it was time for us to move to a new stage and shed the skin and move to something different. So I went back to Guillaume Jacot, the head of Equistone, and I said to Guillaume, look, Guillaume, it's time for a change. You made a great deal. But I think now it's time to move on and to find a new shareholder, which is going to help us do different things and bring new capabilities. And he said yes. And then we did it, and it was a great deal for them, and it was a great deal for Goldman Sachs as well.
And in this new sale, how did you position the company to Goldman Sachs? How did you pitch the company to them? And a follow-up is, what were these new values that Goldman Sachs were bringing into the table for this new period that happened from 2017 to 2020?
Well, yes, you are right, Matthias. I mean, the company was very different because it was making money. We're growing fast and making money, and we had some experience of build-ups. I think what we said back then was to say, look, we are a growing, profitable company in a space which is the comparison space and the brokerage space in France, which is actually a growing space. And now, which is a well-established space with a lot of room for growth, because compared to the UK or to a lesser extent to Germany, especially the UK, that space is still small. And we think that as people go online and want to compare and get information and get help from independent trusted players, and not only the banks and the insurance companies, which are our partners, but are still not fully independent because they will sell you their own products. We felt that space was offering a lot of room for growth, and we had a track record of revenue growth, EBITDA growth, and build up. We knew how to do acquisitions. So I think that what convinced them, which is the space is fantastic. That space for comparison and brokerage is a great space. The market is growing. People go online. People want to compare. People want to get best advice. And we know how to do it. We have a track record now. We are not the troubled company of 2011, 2012, but we are a successful, growing, profitable company. So it was a different story. And I think that's the story they liked.
All right, perfect. And a follow-up on that, because I guess at the time, one of the questions that I would have posed you is, how are you so successfully competitive with other big companies around the financial sector? You're competing with big banks, you're competing with insurance companies, with all the big fishes. How are you so successfully competing in these markets?
Well, it's not that we are competing with them. It's just that they are our partners. Because what we do at the end of the day is we find the best product for the customers. And these products are coming from banks or from insurance companies and from asset managers on the savings and investment side. So we do work with them. They are partners. Simply the fact is that whether you like it or not, people go online and people compare and get information, and they get that from us. So the thing is to say that we actually can source products from our partners, I mean, banks and insurance companies, because they've got the balance sheets. And they've got the product design and product management capability and product manufacturing capability. But people come to us because they know when they come to us, and that's a fact of life, they will get information, they will get comparison. And we are addressing that need, which is not easy for a bank or for an insurance company to address because they will sell their own product. And we are providing customers with choice, with comparison, and no one else can do that. So it's a bit of a biological relationship where we are in a sense, talking to customers and they talk to customers, but at the same time, we provide their products to the customers. Simply we allow customers to choose. And that's why we are here.
That's very, very clear. So I'm guessing, I mean, the cash flows were there. Definitely the EBITDA multiple was higher when you sold the company to Goldman Sachs. But then in this new age of 2017 and 2020, how did you create it value? I mean, you were already growing, you were profitable. So how did you create it and deliver value for Goldman in this case?
Well, we simply did what we set out to do. I think the plan didn't change. I mean, it was just really about executing from 17 to 2020 what we said we would do. And the space has grown. Your comparison and brokerage has taken more space on the French market, just simply because customers want it and demand it and enjoy it and take benefit from it. And that's a fact of life. The second thing is that we have been able to, I think, execute properly. And we have expanded in new verticals that were not existent when Goldman came on board, and that we have expanded. For instance, two verticals that came on stream at the moment Goldman Sachs did the deal. One was P&C, car and home and health insurance comparison with Le Comparateur Assurance that we bought in end of 2016, just before Goldman signed the deal. We actually signed with Le Comparateur Assurance also at the same time as we run the sale process to Goldman Sachs. So we went into P&C insurance comparison that was not in our range until then. Then we extended into some B2B sectors in mortgage insurance back end of 2017. So we expanded our B2B range of products, which was very helpful for us and very profitable and high growth as well. And then back in 2019, we entered into a completely new vertical. It was brand new for us, which was savings and investments, by purchasing Mon Financier, renaming it Meilleur Placement, and growing very fast. And now it's growing 20% per year plus. In a space where I think there is fantastic room for growth. If you are an independent and autonomous player, aside from, once again, the banks and the insurance company. So, adding more verticals and growing the verticals and basically responding for clients' demands for more comparison, more help, and more advice.
Perfect. This is extremely interesting. So a question on comparing both periods. What would you say were the key lessons that you drew from the first period, which was with Equistone, and the second period, which was with Goldman Sachs? What are the key lessons for you personally and from a business point of view, and also from the deal-making point of view of these transactions?
Well, I'll come to deal making at the end. I would say it's always the same thing, which are true, which is having a strategic direction and sticking to it, if it's a good one, obviously, and then being relentless about execution. And I'll come back to that in a second. And that drives me to the next point, which is attention to detail. One thing I've learned, and I think that we all have a taste for that in the management team at Meilleur Taux, which is what we did only worked because there was a huge amount of attention to detail in everything the management team did. The whole management team is coming from bigger institutions. Guillaume Autier, who is the new CEO since August of last year, was at BNP before. And our CFO was with a bigger company before, and almost of the management team have come from bigger institutions, but they all have a trait, which is tremendous attention to detail. And a company like us, you cannot succeed unless the management team really goes down into the on the ground and really goes into the details, which is knowing the operations in its utmost detail. And I think that's a very important thing which I learned, which has allowed us to make tremendous progress. Another thing is speed. Whenever we have tried to do things, we have tried to do things fast. We have been able to achieve build-up acquisitions because every time we are very fast in doing it. 8 build-up acquisitions with no M&A banks on our side. We never employed an M&A bank to do the build-ups. We did all of it ourselves with the help of our PE sponsors, private equity sponsors. But every time we have been able to go very fast and do it very quickly. And I think speed is really of the essence. Another thing I would say, that's a bit of a pun at some of possibly the attendees of this session, but we have been very wary of not using management consultants, or as few as we could, because we noticed that for a small company like us, management consultants are very poor at predicting the future. They might be helpful for bigger companies, but we have found that they are amazingly wrong in telling what's going to happen. And they always get it wrong.
And I also guess that, I also guess that you don't use investment banks as well, investment bankers.
No, we don't. We use them for the LBOs, for the selling processes. We use HSBC back in 2013. We had Rothschild in 2017, and we had Goldman Sachs M&A in 2020. But apart from these 3 occasions, we never use M&A bankers for our own acquisitions, the build-up acquisitions. We did it all on our own. I think that was also a factor for success because that obliged us to be, in the details, involved in the deals, do the due diligence with some due diligence, obviously houses, but be all over it in detail. And I think that was a key factor for success as well. But I'll come back to speed. I would say that speed is really of the essence. And for instance, last year in 2020, when we did the deal with Silver Lake, we managed to partner with Silver Lake, and Silver Lake was very quick of their feet in making the deal. And we tried to be very quick as well. And I think speediness of execution is a key factor for success
this is an important point because my next question is, why an LBO so soon? Why sell the company again? And why do you need this new shareholder coming in, Silver Lake in this case? What's the rationale for this deal?
Well, the rationale was pretty straightforward, which is, you're right. I mean, we could have stayed with Goldman for a longer time, but we had been with them since 2017. And basically, we got the sense in the management team that we were going to enter a new stage of growth for the company where we needed to have a clean slate for some period of time. And you do that best when you have fresh new shareholders with a lot of time on their hands. And it was not going to be the case with Goldman. So I felt that, okay, 2020 is a bit of a troubled year. And obviously, if you want to invest a lot, if you want to do major moves in the next few years, it's going to be difficult to do it with Goldman because they will be thinking about an exit quite soon. And we felt that we want to be partnering with people who are not going to be thinking about an exit soon, but have time on their hands. And therefore, we felt that as soon as we got a window of opportunity, let's do that. And so we can actually start from scratch with new shareholders who are going to have a lot of time on their hands, therefore the sale. And that was not going to be the case with our friends at Goldman Sachs because they would be thinking about exits. And you don't come to your shareholder with major investments or major moves if they are 12 or 18 or even 24 months before an exit. It's just not the right time. You've got to do that at the start of a new phase and not the end of the previous phase.
Yes, excellent. And a follow-up, like perhaps you explained the rationale for the deal, right? Now, what lies ahead in the future? What is the perspective for the next 2 to 3 years in terms of the business itself? Like, how do you expect the business to keep growing, to keep expanding, to keep increasing profitability? What are these new avenues for the future?
Well, I think it's pretty much the same recipe for success, which is the first thing is that traffic keeps increasing and demand for our services keep increasing, and the French market is far from being saturated as far as people want to get help with comparators and brokers and independent advisors. And I think there is a lot of room for growth in that respect in the French markets, which is far less developed than the UK market. And once again, to some extent, I can see in other countries like Germany or Italy, players which have taken a lot of market share, more than we have. If I look at all the verticals we are in, our market share is still negligible. In mortgage loans, we have maybe 4 or 5% market share, and people like us have maybe 35% market share. I mean, in the UK, it's more than 70% market share. If you look at savings and investments, the market share of players like us, which are autonomous and independent players, is still marginal. Most of the market share is still in the hands of the banks and the insurance companies. So I think there are a lot of room for growth in that respect. And it's the same for insurance as well. So basically, this is a space which has massive room for growth. And we see companies we could buy, we see organic growth we could generate. And we think that even just on the French markets, we can still double the size of the company over the next few years. And I'm not even talking about doing anything beyond France, which is something we are thinking about as well. And we almost did a big deal outside France a few years back, but it didn't happen. But if I only take the French market, we see room for growth and for doubling again the size of the company over the next few years, and without saying anything regarding beyond the French borders.
Yeah, so those things still remain as upsides for the future. You can still keep with your base thesis. So this leads me to perhaps the final part of the talk, which is how did the deal happen in COVID times? I mean, what was different? What was special? How did you manage that? Because I guess that negotiating over Zoom is not the same thing.
Well, that would be, Matthias, a long story, so I don't have the time. And it's a very, very interesting one because the deal was just amazing. But thanks to Silver Lake, they were very, very quick on their feet. We did manage to do it in the right window. We did manage to do it. We started we started discussions in June, late June, and we signed, I think, by the 13th or 14th of July. Yeah, something like that. I think the 21st, I think. And then the closing took place on the 13th of October. We managed to do that at the time when we were still able to do a bit of face-to-face meetings. So we had some face-to-face meetings. We had some management presentations back in Paris that took place face-to-face at the time when that was allowed. And I think I'm HEC 86. I'm an old guy, so I like face-to-face things. And I think that made a big difference. I know that I know people who managed to do deals completely remotely, but personally, I would have been unable to do that. So we did manage to do it in just that window opportunity, and everything was signed back in July, and then we managed to go for closure in October, mostly remotely. Even though people in Paris managed to get back to the office, and we have always had a presence in the office with people in the office as needed over time. But the key thing was done in June and July when we could actually still meet with people. So I don't know if we would have been able to do that if we had not had any face-to-face interactions. But we did it very quickly because you never know when the window closes.
When the window closes, yes, definitely. So
that's one thing. That's one thing, Matthias, which is another lesson I didn't mention, but there is really one thing I learned over time, which is when you can do something, do it.
Yes.
And do it ASAP. Don't wait because you never know what's going to happen. You never know when the next lockdown is going to happen. And across business, every time you can do something, do it now.
Yes, and I think to end that, let me summarize the key lessons, and perhaps correct me if I'm wrong. I think number one, you said, is the right management team. Number two is having the right shareholders at the right time. Number three is taking bold decisions. And number four, as you said, is speed and execute accordingly. So am I missing something? These are, I think, the four highlights that I take from this discussion with you.
No, I'm looking at, I took some notes before this, and I think, well, I could, go on and talk about many other things, but I think you're right. And also I would add to that, Matthias, look outside and look for benchmarks and best practice examples and people and companies that can provide some inspiration. And for me, once again, there were other LBOs, more mature LBOs and smaller companies, very agile companies, because they also teach you lessons of a different style, but very different. But I think the points you mentioned are important, very important points.
Thank you for that. Now I'm going to ask you a couple of questions from the audience. Maybe we'll take some 10 more minutes. And the first one, it reads as follows. My perception is that the French sector, the fintech sector in France, is behind what we see in the UK and even a lot of Asian countries. Is my perception justified? What are the reasons behind my opinion? Do you have a view on that, Hervé?
I think it's true in some verticals, but not true in all verticals. We are a member of an association called France FinTech, which gather all of fintechs on the French markets. I'm trying to think through the various the maps of the fintechs on the French market. I think it's true in some categories, and not always true. I think it's generally a bit true. There are several reasons for that. First of all, I would mention three reasons why that might be the case. First of all, if you take the banking sector, for instance, I think French banks on the whole are offering a much higher quality of service than, for example, in the UK. I live in London. I work in France. Well,
you know both markets, yes.
Remotely, yeah. I know both markets quite well. I would say the overall quality of French bank is outstanding compared to the average quality of UK banks before the neobanks. So it's not surprising that it's much easier to make headway in the UK as a startup bank than in France, because in France, first of all, most customers are very happy with their bank. And the level of satisfaction with banks in France is actually quite high, much higher than in the UK. And it's true when you compare services, services offered by the traditional banks in France are much higher quality than in the UK. So it's more difficult to stand out in the banking sector. The second thing is that in France, in several verticals, I think people put a lot of value on face-to-face interactions, more than in the UK in terms of customer behavior. And studies and after studies show that the UK is a much more transactional market for retail financial services than France. In France, people do value relationships. In the UK, for retail financial services, it's gone, except maybe for private clients in wealth management. And even then, I think for basic retail financial services, it's completely transactional. I think relationships are out the window. So that gives you more room for digital-driven innovation. That's another thing. The third thing I think is regulation. In many respects, regulation is making in France sometimes quite difficult. If I take, for example, lending operations, mortgage loans or consumer loans, there are several things in France, such as the taux d'usure, usury rate, which is set by law, which is capping rates in France at a very low level. And this is making it incredibly difficult to make money in the loan business if you provide the balance sheets, because the rates are capped. Yeah. And this is providing far less room for maneuver in the lending sector than in a country like the UK, where you can charge 24% or APR. But charging 24% APR or TAEG, as we say in France, don't even think about it in France. It's prohibited by la loi sur le taux d'usure. So there is less room for maneuver. So there are several reasons why. Face-to-face, if you take Robo-Advisors in France, for instance, Robo-Advisors haven't cracked anything on the French market. There are many reasons for that, but I think it's mostly to do with the fact that when you talk about money and the people who have money in France, which are not the young, which are the old people, because only old people have money in France. But most of the time, people want to see someone face to face, and you don't trust a robo-advisor because it's not a real person. And I think that's also something. It's moving. I think new generations are changing, and it's evolving over time.
It will come.
But for the time being, the one with money in France are old people.
Yes, I can see that. So the dynamics of the market are different. The next question, I think we discussed this before this call, and I like it, is, have you ever considered to go public? Would you? And have you missed the slot given how hot the market is these days? What's your opinion on IPO today and perhaps in the future?
Okay, well, I would just give my personal view here, and I'm sure that Silver Lake might have a different view. Although I discussed that's something that we discussed a lot with Equistone and Goldman Sachs. My personal view is that I just don't like it. I don't like it because in my previous life, I was at AXA, and I've seen what it's mean to be a listed company, and I see a lot of constraints and very few benefits. And as long as you can have private equity ownership, providing you capital and room for growth, I would say I wouldn't go for an IPO, because I see with IPOs, I see constraints and reporting constraints and time spent educating analysts who know nothing but nothing, and answering stupid questions. If you can avoid that, avoid it. And I prefer not to think about it. I know that at some point, as we get bigger and bigger and bigger, it might be an option. But for the time being, I prefer not to think about it, because I think we should focus on the business and not focus on reporting to analysts.
Yes, I can definitely relate to that.
Plus compliance and all the rest of it.
Yeah, all the burden that will make your company less agile.
Exactly. But obviously, as you grow bigger, it might become.
Yeah, it might be the only exit option. Next question.
Well, we'll see.
Yeah, well, we are seeing huge tickets in private equity these days.
Exactly.
So
yeah,
may still have 20 more years.
Definitely.
And I definitely agree with you. The incentives are better aligned with private equity than with public markets. The next question is relating to how do you plan such exits with several stakeholders? What are the key points to think about an exit, and how do you go about the sale process and planning, and what's important there?
Well,
you went through 3 processes, so you might have something to say about that.
Well, I think I would say 3 things. I could say a lot of things, but I would say 3 things. First of all, you've got to have all your ducks in a row. By that, I mean that you've got to make sure that somehow you've got your story straight. You've got to have all your numbers lined up, and you've got to be able to deliver a consistent message and tell your story in a very, very convincing way. And everyone around the team has got to be able to do that. And I would say that means also that somehow you should think about it in a way like, okay, we are going to tell you who we are, what we have done, what we are going to do, and you like it or not. And at the end of the day, this is about it, right? I mean, this is who we are. That's what we have done. That's what we want to do. And if you like it, make an offer and work with us. And if you don't like it, just go another way. Yeah. And that's what I call having all your ducks in a row. That's the first thing. The second thing is that I think I would say spend a lot of time upfront, reaching out to people, funds, and find out who you like and who you don't like, and find out people that you want to work with. And I think that's quite important. And if you can do that beforehand, because once the process has started, it's too late. You won't have the time to do that. You've got to know the players before the process is started. Otherwise, you're taken up by the process and you are taken up with the mechanics of it, and it's too late. And then the third thing, which is the opposite of what I just said, is speed. But you can be speedy if you have done your homework beforehand. If you can find a way to accelerate the process and do that, because those processes just swallow up your time. You do nothing else in that stage. And it takes a lot of time from the team. Now, in the deal with Silver Lake, we did something very, very unusual because we didn't want to disrupt the company. We decided with the CEO and the CFO, with Guillaume Mottier and Tom McKenzie, plus only a couple of the people, to do it all with full confidentiality. So we decided that it was going to be very unhelpful to bring the whole team on board and to tell everyone about it. And if we said, let's try to do this thing as close as we can with a very small team and see what happens. And that way we were able to go very fast and to be very discreet. And that was successful. But, being speedy, prepare a lot. And when you are ready, go as quickly as you can, including if someone is able to do a preemptive bid, go for it.
And this brings me to the last question that I'm going to ask you tonight from a member of the audience is, what does Silver Lake bring to the table as a tech fund that other funds that are more generalistic can't bring into Meliorto? What is the value added of Silver Lake in this third LBO?
Well, the first thing is that the first thing they did was that they really spent some time to try to find out who we were, even though we didn't give any numbers to anyone before we started having some management presentations, and we didn't give any advance info to anyone. They spent time from the outside researching us and looking at us and getting to know us. And we spent a bit of time just getting to know each other. And I think we got to the point where we felt that there were people we could work with. And second thing, they seemed like people where they could decide things very quickly, which was an important point for us. And thirdly, in the deal itself, they were very quick, very quicker than anyone else. And the final thing is that they are really specializing in tech. And it was pretty clear to us that we'd be able to bring to us some know-how and some experience of other companies, very tech heavy, and that was for us an important point as well.
Great. I think we are on time, Hervé. So I think this was an amazing presentation. We've all learned a lot. I think everyone is quite happy about it. So let me thank you again for your time. I know you're quite busy, so having with us 1 hour of your time has been really amazing.
Okay, thank you, Matthias, and I hope that's helpful. And good luck to everyone.